Hey, how's it going, everybody? It's November 1st. Here in my lovely downtown condo, just as the moon sets in on the evening. No, I'm just kidding. I'm here in my bedroom. But I have a trade recap to share with you all this evening. First week in November, it's a non-farm payroll week. And we had FOMC today as well. So I like to get done early on those days, preferably even before the New York AM session if possible. And I want to just go briefly through this trade with you all. I'll do a quick recap on the charts, what I saw beforehand setting up for the trade, and then I actually have the live trade video recorded so I can tell you how it played out, how I executed, how I moved my stop loss, and how I managed the trade. So I'm going to jump right into my charts, and we will get going. All right, so this trade was on the NASDAQ. I monitored the NQZ 2023 charts for the trade, but I traded it on the micro contract just so I could build up a position and show an example of pyramiding. So I'm just going to chart it out here on the micros so I can show you exactly what I was looking at. So on the daily chart here, we traded down into what's a little imbalance right here. You can see it clear if I just jump over quickly to the NASDAQ chart right here. You can see this as a complete liquidity void. No trading took place between this candle's high and this candle's low. It's not quite the same on the micro contract, but normally you want to do your charting on the mini, not on the micro. But we'll just take a look at this here so I can give a better example of what occurred throughout my actual trade. But anyway, trading into that imbalance, then moving off of that low after running out sell side liquidity under these lows and into this imbalance. So we can have a daily retracement back into the dealing range and up into some inefficiencies that remained up here, right? We have this SIBI. That's the difference between this candle's low and this candle's high. And you would include the volume imbalance here as well. And then there was that volume imbalance as well, which traded yesterday, right? So now we were getting into Wednesday. I was expecting a potential deeper retracement into this range to work up into the midpoint of the SIBI and then up into the high. And so I was expecting yesterday's high to trade through, which I have marked out right here. And then I marked out the daily SIBI high as well. All right, now I'm going to jump down into a 1 hour chart. Everything will be transposed over here. So just marking out a couple other levels, right? Here is the previous day's high that I was expecting price to trade through. And then looking to the left, what do we have over here? Another SIBI on the hourly chart, difference between this candle's low and this candle's high. And it's already been partially redelivered right here. So I'm just marking out that candle's high and expecting price to trade into that high and the remaining portion of the SIBI. So I can mark that out right there. That was what's left of that inefficiency. And then if we do trade beyond there, to continue trading up higher into some of these remaining inefficiencies right here, there's a small one right there, and then up here, which is in alignment with the daily SIBI high. Okay, from there, I'll drop down into a 15-minute chart to just show the framework for the trade. All right, so right here, you can see yesterday on Tuesday, the lows were purged down here, and then price ran up, shift in market structure above this high, and then price retraced down into what? We have the last down close candle right here. This is the bullish order block. And then that's in alignment with a BISI there. So that's the separation between this candle's high and this candle's low. So price trades back down into there in a discount of this dealing range, right? And the lows are run out. Again, doing a stop run into an inefficiency and setting up a model to trade higher up into the buy side, in line with the daily bias of trading higher, right? Price trades up, trades through the highs, drops back down into a 15-minute inefficiency right here. And this is where I want to jump into the example of AMD. That's accumulation, manipulation, and distribution, right? So if you think in terms of how a single candle has an open, a low, a high, and a close, just like this candle right here, we have the opening price, the low, the high, and then it comes back in and closes right there. So just like every candle forms like that, what happens is when the candle opens, initially you'll have accumulation, which will look something like this, right? And then you'll have a manipulation. So if it's going to be a candle that ends up moving higher, you'll have a manipulation lower first, something like that. And then as the candle moves back through the opening price, you'll have your distribution, and you can work up higher like that. And so this is kind of the framework that I'm looking for on all time frames to help set up the actual trade. So you can see here on this chart, we have accumulation occurring right here. Right there. And then you have the manipulation occurring down through here. And then you have the distribution working back through the opening price and up toward here. Okay, so that's the accumulation, manipulation, and distribution. And then since everything is fractal in price, meaning that I could see the same things occurring on a daily chart as I could see occurring on a 1-hour chart or a 15-minute chart or a 5-minute chart or a 1-minute chart or even a 15-second chart, which you'll see inside the trade example from today. What that means is that I could see this same framework occur across any time frame, right? So see how we have the accumulation here, then the manipulation, and then the distribution? That's the same thing that I was looking for inside these 3 candles right here, and then up toward my targets up here. So what I'm going to do is mark out just these 3 candles like that. And then I'm going to go into a lower time frame, a 1-minute chart, and I'm going to show you how we have accumulation, manipulation, and distribution occurring just inside this fractal. Okay, going down to a 1-minute chart. Get rid of that. If we look right into here, you can see the same thing occurring. Right? So we have that accumulation, manipulation as price drops below the accumulation here, and then distribution, working back up higher through that accumulation and moving up toward my targets up here. Okay, so that's the framework for the trade. I'm going to go ahead now and jump into the actual recording of the trade. There we go. And I'll walk you through my idea for how this developed and how I executed the trade. So you can see here, I've got a 1-hour chart up here, a 15-minute chart right here, and then here is actually the chart where I go between the 1-minute, the 30-second, and the 15-second chart. Right here on the 15-minute chart, you'll see how price was accumulating, manipulating down, and then moving up through buy-side liquidity, which was yesterday's high, then dropping down into an inefficiency right here. This is a buy-side imbalance, sell-side inefficiency, right? So between this candle's high and this candle's low, there's an inefficiency where only the buy side is traded, and the sell side still needs to trade back lower. So you see price drop in here down to the midpoint, right? That's called the consequent encroachment of this buy side imbalance, sell side inefficiency. So between this candle's high and this candle's low, that's the midpoint right there. Price drops right down into there, just back below the midnight open as well, which we can use to identify the opening price from the day. So if we're looking at this as if it's one single day's candle, you have the opening price, that accumulation here, manipulation, and now as we trade back above it, I can expect distribution to occur above the opening price, right? So we're dropping back down in the opening price, and that's where I'm looking for my trade to occur, because I'm expecting this to be manipulation, and then to see distribution higher. So that candle dropping down is exactly what we're seeing right here. Okay? As price comes back up, that's when I look for an opportunity to enter and target the buy side up here, which is going to be above this candle's high, and then for my higher targets. So here, what I have here is a SIBI on the 1 minute chart, sell side imbalance, buy side inefficiency between this candle's low and this candle's high. Normally, if price were bearish, you could expect price to trade up into here and drop down. But since I'm bullish and I'm expecting the buy side to trade, I want to see this used as inversion. That means I want to see price trade above it and use it as a discount array to actually trade higher rather than trading lower off of it. So as price trades back down into it, I'm entering my long position and I'm placing my stop loss down here below this low. On a 1 minute chart, you'll see that there's a buy side imbalance, sell side inefficiency right here. And so I'm putting my stop under that. Price should no longer trade under this low. I'm just giving it a little bit of extra room in case there's a little mohawk below that. Here's a 30-second chart. And there's a small inefficiency you can see in there. So I'm adding one more right there. I'm now up to 4 contracts. As price trades back down into this area again, I can add another. Here I've got what I'm seeing as an order block on the 15-second chart. So as price trades down, I'm adding another inside that down close candle. See price trading now back into that inefficiency, just dropping down to the midpoint, but watch how the candle closes back at the high. So I'm adding another there. Now I'm at the 6. And now what I'm looking at here is this last down close candle, marking the high to the low. That's my mean threshold, which is the midpoint of that order block. And as price taps down into it, I can add one last contract to my position. Here I'm just marking out my dealing range, seeing where equilibrium is. And this is my implied dealing range from here to here. So I don't want to add any pyramid positions above equilibrium of that implied dealing range. Now I'm looking at my final pyramid right here. So I'm using the wick of this candle. It was previously looked at on the lower time frame as that bullish order block, but now I'm looking at it from this low to the closing price right there, which you can see as the wick of this down close candle. The consequent encroachment of that, which is going to be the midpoint, is where I'm looking to add that final position. As price taps down into there, which we see right there. And now we can move away quickly from there. I'm up to 7 contracts at this point, leaving my stop in place just where it is. And now I'm expecting price to start running up toward the buy side. I'm going to go ahead and start putting my limit orders out to exit the position above the buy side. Here I have a 1 hour SIBI. So I'm putting one limit order at the midpoint of that. And then I'm putting one at the high as well. And I'm going to take 4 contracts off just above buy side liquidity. So you can see here how we're developing that accumulation, manipulation, and distribution, right? AMD. So here's the accumulation, dropping down as manipulation, and then distribution up higher. And you can see hitting my first target right there. At this point, my stop is now above break even. Just allowing price to continue to trade and be supported by the arrays beneath it. So there's a small inefficiency right here. There's this volume imbalance right there between those two candles. And then there's this wick right here. My next limit order's hit right there. And now you can see that I am using I'm looking at this as a fulcrum point, right? So between this low and this high, I'm taking my fib and drawing it across that and doing one standard deviation, which is where I get this level 14,557 and 3/4. And that's where I'm going to put my my final exit, my terminus up there. So now price is trading just back into a BISI, a buy side imbalance, sell side inefficiency on the 1 minute chart. I'm taking my stop loss up just a little bit, but I'm still keeping it below the wick of this candle right here. So I'm allowing price to trade back into that and treat it as a gap if it does so. And now my next limit order is hit right there. So I move my stop up just a little bit. You'll see in just a second. Now I've moved it up, but I'm keeping it below this up close candle right here. So what is that? That's my what I'm using as a bullish breaker, right? So we have the low, a high, we've got a low, a high, lower low, trading through. And this last up close candle is the bullish breaker. So low, high, lower low, trading through. And now at this point, price can retrace to that breaker, but I don't want to see price trade below it. So my stop is going there. Here you can see a little stop run occurring, just running below this candle's low, but still inside the buy side imbalance. And this level here is the consequent encroachment again between this candle's high and this candle's low. It's the midpoint of that. So allowing that area to trade. Dropping down into the consequent encroachment. See how the body closes above that consequent encroachment and then immediately ripping higher. Now the 930 open is hitting right here. My stop goes up, still below this inefficiency right here though. So allowing that to trade if price does run back below the low one more time. And at this point, I'm okay with getting stopped out, right? Because I've already taken off partials to pay myself on the position and I've moved my stop into profit. Now as price trades above the high, I'm moving my stop toward the low of these down close candles, treating that as an order block. And at this point, I don't want to see price trade below the mean threshold of that. So if I take the high to the low and mark that out, I'll see the midpoint, and I don't want to see price below that. Now I'm using the breaker again, low, high, lower, low, and trailing my stop to just below. I also have these down close candles treated as an order block. Now just giving it time to play out, right? That's again the breaker right there, looking at this wick, that's seeing a low, high, lower low, trading through. That's the bullish breaker. Now we're trading back up into the midpoint of that 1 minute candle's wick. Back down to the breaker here on the 30-second chart. And at this point, I don't want price trading back below that candle's wick. So my stop is just there, just under the low. Note how we're using this over and over and over again, allowing positions to accumulate right here. And as we reach through the high again, I trail my stop just a little bit more, just under the closing price of this last down close candle. And then there's the run up toward that 1 standard deviation. Here's the executions. And you can see here across the 1 minute, 30-second, and 15-second timeframes. So here's that original accumulation, the manipulation down here, and then using that 1 minute inversion SIBI to start accumulating my position right here. First adding just inside of there, then we drop down, hit the consequent encroachment of it. I add another right there. And then as we drop down into what on the 1 minute is the consequent encroachment of a wick, and on the 15-second chart is the mean threshold of this order block. I'm adding my final pyramid right there, taking it up through the buy side, taking my first exit there, my next limit order at the midpoint of the 1 hour SIBI, next one at the high of the 1 hour SIBI, and then finally up here at the 1 standard deviation of this fulcrum point swing projection. All right. So that's the trade. Hope you all enjoyed. Let me know if you have any questions on this one. And if you like these, give the video a thumbs up. And otherwise, come join us at firsthandtrading.com. We got a lot of great stuff going on. We got weekly calls on Sundays at 10 a.m., giving you the pre-market analysis and reviewing the previous week. And we've got midweek reviews every Wednesdays, and training exercises to help you continue on your journey and continue developing as a trader. And we're going to be implementing a lot more cool stuff soon. Come and check us out, firsthandtrading.com, and we'll look forward to seeing you there. All right, take it easy, everyone. Take care. As always, be safe, be responsible, and I'll talk to you soon.